exciting, and that's why my subscribers and clients are quite happy. Today, I'd like to spend a little time talking about success and failure, opposite sides of the same coin. The first thing we could talk about is success. I touched on this last week, but it's something that I can't reemphasize more and more. The kind of success I'm talking about is how are you going to make a lot of money on the times that you are right. Over the years, the top pros tend to be right about 30–40% of the time with the trades they pick. And obviously, if you're only going to be right 30–40% of the time, you better be making big money on those winning trades, because somehow you've got to, be able to pay for your losses. So, as I said, we're going to talk about success, and I'm going to give you some more examples today of how you make that success happen. Okay, let me try and find a chart. Let's see. Let's look at Australian dollar, Japanese yen. Okay, here it is. Okay, what you see here, this is the daily chart, Australian dollar yen, and we see a bottom being formed or was formed over here. Okay, that's important because some people may disagree, but most of the top pros over the years will tell you the biggest money is made at tops and bottoms on the turns, okay? And this is a very good example of it. In order to do that, we have to know when there is a top or bottom. The first thing that tells us if there's a top or bottom, in this case, a bottom, is that we have what's called divergence down here. Price is coming down, it keeps making lower and lower lows, but the indicator, our momentum indicator says, no, we're not going down, we're going to turn around and reverse. The second hint that there's a reversal is the change in the dots. These dots are the parabolic stars. You can read about the math behind that, but what it is showing us is a change of direction is coming. So when the dots flip from going down to going up, that's the second sign to me that there's been a reversal in price. The third important thing to notice is this long wick down here on the candle. Do you know what's happening there? What's happening is that as price keeps going down, there's a lot of people who think, it's time to turn around and go the other way, so they're going to start buying it. And they start buying it here and here and here, and it keeps going down. In the end, it's going to turn out that they were right, that there was a change of direction, a big move up was coming, but they're going to lose it. They're going to lose money anyway. And the way they're going to lose it is that this long wick, what that is the market taking out all the weak stops, all the weak players. And this wick can be very long. The market will make it as long as it has to, 100 pips, 200 pips, doesn't matter. They're going to get almost all the stops when the change of direction is coming. And, once we do get all the stops, then we're free to reverse and continue to the upside. So that's the third thing we see. One was the flip in the dots from down to up. The other was the divergence. The third thing was the long wick, telling us they're taking out all the stops. The fourth thing is a pattern. In this case, the pattern turns out to be a head and shoulders. And it's the left shoulder over here, a head here, right shoulder here. we come up to a point where we can draw in the neckline. And the neckline, will have normally 2 touch points on the left side of the head and shoulders, that will have 2 touch points at least on the right side. And when it comes up through the neckline, that's where we buy it, right there. We saw a lot of things happening before this to tell us to change the direction, but we're going to buy it on this line. And the reason we are is because there's only a single price on that line. And that's where we can take our smallest risk. Above the line, we want to be long. Below the line, we want to get out. And this is really the only place on this chart where you can, have an exact spot to make a buy or a sell. And it's the reason for failure by, most of that 80-90% to lose, because even though they may be right about where the market's going, since they get in at the wrong place for the most part, they have nothing to lean on. So, they'll end up getting stopped out, and then they'll miss the move, even though they were right about the move. You can be right in this business and still lose money if you get in at the wrong place. If you got in down here and, then all the stops were hit, you're going to end up being taken out or reversed, and you will have been right, but you're going to lose money. So the important thing is not just being right, but where do you get into the trade, the point with the least risk? And that's always been a specialty of mine, and I think it's why I'm still around after 25 years, because I'm able to control risk. And there are a lot of people who make a lot of money. I mean, it's not that hard to pick winners, but and to make money, but keeping it is quite another story. Most people, even when they do make money, they don't know how to keep it, so they end up giving it back plus a lot more. Okay, so we got long on this trade right here, coming through the neckline. Okay, but that's not the end of it, because as we said, we've got to make a lot of money on this 30-40% of the time that we're right. So the way we do that is we wait for consolidations to develop when they come through the neckline of the pattern. This could be a head and shoulders, could be a triangle, could be a rectangle. But when it finally breaks out, it's not going to go straight up forever. It's going to go up, and then it's going to go sideways, which is called a consolidation. During that consolidation, the market's going to hit a lot of stops and take out all the weak players again. And that will continue. But what do we do? Well, what we do to make our trade bigger, as we see these consolidations develop, we draw in lines to tell us where we're going to make our add-on, where we're going to add to our position. So in this case, it was a downtrend line right here. And when it came up through the trend line, we bought more here. So now we're in a position where we've made a purchase here, and coming up through this downtrend line, we made another purchase here. We've added to the trade. And the important thing is that when we add to the trade here, we don't put our stop down here. We put our stop just under the line like we did, on the head and shoulders. So even though we're adding to the trade, we're really not adding to our risk, which is, a very important point. So that's the first place we add. Then it runs up again, and then goes into another sideways to down consolidation. When that happens, we're able to draw in our line again. And when it comes out the top of that consolidation, we add to the trade. And then it happens again up here. So what started out as a trade down here is now 4 times the size by the time we're up here. And that's how we're going to make a lot of money on these trades that we're right on. How will we know when to get out of this trade? Well, 2 things. One, head and shoulders is measurable from the bottom of the head to the neckline, and then we extend it same distance up, and that's how far we're going. Of course, that's always a minimum. We could go a lot farther. Markets tend to do that. So what you do is when you reach the measurement, you take a big chunk of profit, 70, 80% or so. And then when you see divergence up at the top, that's when you can get rid of the rest. Just the reverse of what you saw down here. You'll see this happen again up here. It'll be just the upside down, but that'll get you out of the trade finally. So I never like to take myself out because the market's always smarter than we are. So what we can do is we can wait for the divergence to develop, and then we can put in trailing stops. That way you don't have to guess. Let the market take you out. When it runs up, runs up here, the last 100, 150 pips, you could put a trailing stop in, 50 lower, 50 below that, or 100 below that, and let the market take you out. That works out much better because, like I said, the market's smarter than all of us, and these things can keep going for a long way. Very often I had situations where I had a measurement of 300 pips for a move. It went to 300, but then it went another 300. And very often I missed that. But I've since learned that if I let the market take me out instead of myself, I'm going to get a lot more of the trades than in the other way. So that's the success part of what I wanted to talk to you about today. Now, the other side of that coin is the failure side, okay? In this head and shoulders here, everything worked correctly. We made the bottom, we drew the neckline, and we went through the neckline, and it worked out, the way it was supposed to work. But what happens when it doesn't work out the right way? When the pattern fails, okay? The thing is, even though the pattern fails, you don't have to fail, okay? And the way you do that is by reversing your position. Let's see if we can find a good example of that. Let's see. I was looking at New Zealand, Swiss right here. Okay, here's a good example right here in the middle of the chart where this red arrow is. This happens to be a little tiny head and shoulders consolidation. And here's your left shoulder, here's your head, here's your right shoulder, here's your neckline, okay? And that head and shoulders pattern, might indicate that that's a top of the market, and it's going to, turn around and go down. So we see that. We see some divergence here. We see the flip in the dots here. We draw in our neckline, and it goes below the neckline as it should, as we expect, okay? And it's hopefully beginning a big move like the chart we had just looked at before. But look what happens. It comes a little bit below, it kind of stalls, turns around, goes up above the neckline, and fails totally. So what could you do here? You knew, for example, that the neckline was the important pivot for you. Below that, you wanted to be short, okay? But we could add something to it and say, okay, below that, you want to be short, but if it turns around and goes above it, we're going to reverse our position and get long. And look what happened, okay? The head and shoulders top failed. We reversed it coming up through the line, and we got a tremendous reward there. So the point here is that, it either has to be A or B. It either has to be a head and shoulders that is successful and is going to go through the line and keep going down, or if it's going to stall, turn around, and go the other direction. And when that happens, you can make a lot of money for a lot of reasons. Number one, there's a lot of people here who were short, and you're going to hit those stops as it starts going up, and it could be a real violent move in your favor. And people, like I said, people will be scrambling to get out when they're wrong, and that can help you a lot. So that's what I wanted to cover with you today. Two sides to the same coin, one success, one failure, and you can do well in either case. With that, I'll look forward to seeing my subscribers with my posted trades during the week. If people who want to go more in depth to this and learn how to do this yourself, you can always think about taking my course, which is outlined, at Ticker Tacker. And with that, I want to wish you all a good week. Happy trading, and we'll see you next week.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.